It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Asian stocks struggling for traction after Wall Street's tech rally as Fed officials call for further evidence of cooling inflation before cutting rates. Economists surveyed by Bloomberg raising their China growth forecasts, citing a better outlook for exports even as consumer spending slows. Plus, the RBI governor says India's annual growth is moving steadily towards 8%, but issues a fresh warning that the inflation fight is not over. Let's do a check on how markets are faring. I guess people are just waiting and seeing what the PC brings. Avril Hong is on top of that, Avril.
Yeah, really want to find out exactly how the inflation fighting picture in the US is faring. But today we are also keeping a close watch on assets in China. Stocks there are the decliners, bucking the trend in the rest of the region. We're also seeing continued demand for safe havens, and the yield on the Chinese 10-year government bond has fallen to a more than 2-decade low, perhaps raising the risk that we see some pushback from the PBOC. Elsewhere, it is a tech-led rebound, tracking the performance of NVIDIA. But as I say, it's really about inflation. We're waiting for the PCE numbers later in the week. But in the meantime, we did get some numbers out of Australia. CPI hotter than expected. So selling in stock markets, the bonds there also coming under real pressure. The Aussie dollar is gaining ground. Let's flip the board and dig a bit deeper onto what we're seeing down under, because it was a third straight month, flip the board if we can, where we actually saw a climb that was more than forecast. So it raises concerns that rates there are just not restrictive enough. Certainly, we heard from the RBA governor just last week, Michelle Buller, talking about how that rate hike potentially is not off the table. And we see after the CPI print, swaps traders raising the bets that there's a chance of a rate hike come August. This is coming at a time when other central bankers, another Michelle Bowman, sounding also quite hawkish and saying that there is a willingness to raise rates if needed. Have a listen.
We're still not yet at the point where it's appropriate to lower the policy rate. I remain willing to raise the target range for the federal funds rate at a future meeting should progress on inflation stall or even reverse. Given the risks and uncertainties regarding my economic outlook, I will remain cautious in my approach to considering future changes in the stance of policy.
Sticky inflation and a headache for central bankers, Has.
Well, that's right. And that debate continues. Let's bring in our first guest today, who says a trajectory of gradual rate cuts by the Fed is positive for risk assets. Wei Fok Hao is CIO of DBS Bank and joins us here in the Lion City. Wei Fok, good to have you with us. Bowman says the risk is to the upside. It is not the time to cut rates.
Yeah, actually, if you look at the risk reward in bonds today, it's very, very attractive. So an investment grade portfolio would yield about 5.5%. If you do see rate cuts, you could get returns of high single digits over the next 12 months. You will only lose money if the Fed makes a U-turn on their policy guidance and raise rates up to 4 times. So you can see that there is margin of safety, and the risk reward is very attractive.
But she says it is not time to cut rates yet. We may not see those rate cuts yet. When you take a look at the bond market, traders pricing in a cut of 300 basis points by March. Therein lies, I guess, the disparity between the two sides.
Yeah, so there are guidance from the Fed officials that are also data dependent, right? So it depends this week if there's some softer data on inflation, then things would change. But really, how we want to advise clients to construct their portfolio is, number one, extend duration, because bond yields have backed up this year. But have, I would say, overweight positions at the very short end because it's an inverted yield curve. And on the long end, buy into credits because that's where credit spreads are the widest.
So buy duration, you say?
Buy duration, but at the same time, barbell that portfolio construct.
ECB expects to ease as well. Same story?
Yeah, I think ECB, we have seen Swiss National Bank easing rates. I think we are not far from the peak in terms of monetary policy, including the US.
When it comes to bonds, we also have to talk about Chinese bonds. We heard from April just slightly earlier how yields at the lowest in more than 20 years. How do you play the Chinese bond market? It's been a stellar run. Will that run continue?
Yeah, so we are more US dollar focused. So when clients buy into local currency bonds, obviously when rates come down because of a slowdown, for example, in China, you would get capital gains on your bonds in local currency terms. But we have to be cognizant that there are foreign exchange risks here. So really the way to play is if you buy into local currency and you hedged it back to your base currency, US dollars, make sure that your total return is as attractive as just the local currency return.
Of course, the Chinese bonds are looking attractive on the back of a very lackluster economic growth forecast for the country. Yet, we heard from Li Qiang just yesterday that he is confident China will achieve that 5% growth. All things considered, Wei Fok, I mean, even the like of stimulus, for instance, up to this stage, I mean, can China get to 5% this year?
I would think so. I think, the long-term fundamentals are there. Savings still remain high. I think what is lacking is confidence, consumer confidence. And once that, kind of bottoms out, I think we should see, the trajectory of rates, of growth coming back.
And of course, that confidence is contingent on how the property sector plays out for the rest of the year, whether or not China can stabilize, not just the sector, but property prices as well. Where are we with that? Yeah,
I think they have introduced a couple of policies. They're moving in the right direction, I would say. So it's, it's a good sign for policy to kind of stabilize the property sector.
What are the risks?
The risk, I think, would be another kind of a wave of, lack of confidence across, defaults, which a lot of it has already been factored in. And with that pool of savings, I think, we are not far from the bottom. Yeah, what we need is really a trigger and in terms of building up confidence.
You're expressing more confidence than most people, I think. S&P is saying that you should expect a new wave of defaults as soon as next year. There's been a lack of those defaults as expected this year. It will play out in 2025. Your thoughts on that?
Yeah, so markets are always forward-looking, and a lot of that default or negative news have already been priced in. So there is a price for everything. So the way we kind of look at the markets today is, there are, the US technology stocks, which was the main driver of returns, but we think that there is a room for laggards, be it energy stocks, financials, healthcare, or emerging markets, including China, being that their price earnings at low teens compared to technology US at 30 times. So I think a lot of it has been priced in. So it's not a bad time to re-engage in them. Yeah.
If everything or a lot of the bad news has been priced in, I mean, how do you explain the lack of interest in Chinese assets? You take a look at the yuan, for instance. It remains lackluster. It expects the PBOC to prop it up with its fixing every single day. I mean, how do you make sense of the lack of interest?
Yeah, I think on the back of, investors, traders' mind is really the dollar. So the dollar is really the overarching currency in terms of its strength, not just against the yuan, but against most currencies across the world. Now, when the Fed starts to ease up, I think we'll have some of these pressures kind of being relieved, and some of these local currencies should be able to come back. Yeah.
So we're looking at a weaker dollar by the end of the year. How much weaker are we looking at? What kind of crossings should we be looking at?
So it depends again on data, but we think we are not far from the peak. Lower rates from the Fed, from the markets should usher in a weaker kind of trajectory for the dollar.
So some relief for the yen going forward.
Yeah, we hope so. It's been a tough call. I think a lot of market investors have been predicting a stronger yen based on a very simple fact: it's very, very cheap, based on purchasing power parity and what have you. But I think once the dollar kind of loses its strength, then the yen too would appreciate.
A lot of talk about intervention from the BOJ or even from the Ministry of Finance. At what level do you think we would see actual intervention, not just verbal intervention, but actual intervention?
Yeah, today we are about 160. So I think if indeed the yen kind of gets sold off in a very aggressive manner, there will be intervention. Otherwise, it would probably be more, talking up the yen rather than really intervening in the markets.
Okay, the yen level at the end of this year?
We are looking at a stronger yen, so in the order of 150.
Let's talk about tech. We saw how NVIDIA dragged down the S&P and it recovered somewhat yesterday. Still a believer in tech?
Certainly. I mean, AI, we have been pounding the table on AI since a year or two ago, and we said these companies will generate real earnings growth. It's not just what we had encountered during the dot-com bubble where there was no real earnings. And you can see, AI, it's driving the returns, not just on semiconductor, the infrastructure play, but it's driving returns on the cloud platforms, on cybersecurity, software services companies. And really, AI is just in its early innings. So we continue to like this growth, secular growth story is in our kind of growth side of our barbell construct. Income generators on one, secular growth on the other. Interesting
that you're also looking at the new frontiers of tech. And here, of course, interesting that we're talking about it on a day when we're also talking about how China sent its spacecraft to the other side of the moon, the far side of the moon, and it was a successful one. And you say that there is a play for that. I mean, in terms of a space trade, so to speak.
Yeah, so at DBS, we always kind of look out for the next trend. And we spotted AI, and that has worked out well and continue to work out well. And as you kind of look across what's happening in the world, the speed of innovation and technology has been so fast. Today, we've got autonomous vehicles, we've got intelligent robots, reusable rockets. So never too early to kind of look deeper at what's going to happen, with space. And really, what we like about this is, the expressions, investment expressions today rest or lies more in the private markets, the likes of SpaceX, for example. Now, public listed companies, aerospace companies, for example, will benefit, but it's still early stage. But what we feel is that the revenues from space economy will only grow.
You're talking about space tourism as well. How do you play that?
So the most monetizable aspect of the space economy is really the launching of satellite constellations. And how revenues are derived from that is really subscription for internet broadband access. Today, 1/3 of the world population has no internet access because there's no fiber optic, infrastructure, there's no cable. So, satellites will provide that, and that's the revenue. Now, there are other kind of sources of revenue. Tourism is one. It could be, Earth observation. That's also satellite, kind of revenue generating stream. Tourism, and there are some futuristic stuff which I think will not come so soon. Mining, asteroids, and whatever you. Yeah.
All right, it's all about innovation. Wei Fok, thank you so much for that. Wei Fok Hao, CIO of DBS Bank. Well, still to come, we head to the World Economic Forum in Dalian for a conversation with former U.S. Assistant Secretary of Defense Graham Allison on rising tensions between the U.S. and China. Keep it here with us. This is Bloomberg. Welcome back. Asian stocks treading water ahead of the PCE report out of the U.S. Investors looking for more clarity, indication, signs perhaps on inflation cooling to prompt rate cuts by the Fed. Remember that the bond market expecting 300 basis point cut by March, though we heard from Governor Michelle Bowman saying that the upside risk remains to inflation and that perhaps those cuts may not be appropriate. Take a look where we are in terms of the Hang Seng Index, down by 0.2%. The ASX 200 Index lower by 0.8%. Of course, Australia's CPI coming in faster than expected, that for a third straight month in May, sending the currency higher as traders boosted bets that the RBA will resume raising rates at its next meeting. In terms of the TAIEX, currently up by 0.5%, the Kospi also in positive territory. We're keeping a watch on tech stocks, in particular NVIDIA rebounding on Tuesday after slumping the day before that took its valuation below that 3 trillion mark. Of course, Asia in particular also keeping an eye on the yen. Front and center, the next pain point for the yen, perhaps potential trigger for intervention, maybe that PCE out of the US. Remember, it is all about rate differential. That's what it is important to wait and see what happens with that PCE report out of the US. Let's get you back to Dalian, where the World Economic Forum is underway, and our own Stephen Angle is on top of that. Steve.
Hey, Haslinda. Yes, our guest this hour is Graham Allison. He is the Harvard University Professor of Government. You are also the former Assistant Secretary of Defense under the Clinton administration in the 1990s. Correct. Okay, so you wrote a book called Destined for War, 2017. Now, I know it's all about the Thucydides trap, that a rising power inevitably would overtake an established power, and that could potentially lead to conflict. Tell me, please, we are not headed for a conflict militarily, but more commercially.
Well, the good news would be if that were true. The bad news is that, unfortunately, it's not. So what Thucydides taught us is that when a rapidly rising power seriously threatens to displace a major ruling power, this shift in the seesaw basically changes the tectonics of power in the world, all around the world, and disturbs everything on the surface. Everything on the surface. Now, under those conditions, most often, the two parties find themselves ending in a war. Not every time, fortunately. In the last 500 years, 16 times we saw this story. 12 of them ended in war, 4 in no war. For example, the Cold War, the reason why it was called the Cold War was that it was in every respect like a war, except without bombs and bullets by uniform, so it was cold.
Came close.
It came very close. So the answer to the war between the U.S. and China is not inevitable. But if Thucydides were watching, he would say the two parties seem pretty much on track for business as usual, and business as usual will turn out to be tragic.
But some steps are being taken, obviously. The United States has taken steps with the export controls, with the tariff regime that came over from the Trump administration. And, of course, there's just this allegation by China that the United States is trying to contain China's rise. Do you see it that way?
Well, I would say yes and no. It's complicated, but in principle, the ruling power never wants to cede its position to a rising power. And why would it? Excuse me, from an American point of view, which I hold, the international order that the U.S. built after World War II has been the framework that's provided for the best world that we've seen for 78 years. Amazing thing. Peace, stability, huge growth and prosperity. So the Americans, we believe, from an American point of view, the American role in Asia, with our alliances with Japan and South Korea and Australia, and the American Navy as the arbiter of events in the Blue Water, and America as a nation power, we think this has been hugely beneficial. But from a Chinese point of view, excuse me, this is called the South China Sea. Why should you be the arbiter? This is the East China Sea. Why is your ships determining what's happening in the Philippines? This should be between the U.S. and the Philippines. What are you having to do with a conversation about Taiwan? This is between one part of China and another part of China from Beijing's point of view. So historically, that dynamic makes, in every instance, the rising power thinks the ruling power is trying to hold me down. And in some ways it may be. And certainly in the AI space and advanced semiconductors, as Jake Sullivan has rightly said, the U.S. objective is to maintain the largest advantage it can in every frontier technology that will have implications for security. Well, that's basically the whole new technology frontier.
How are we going to avoid, though, that conflict? Because China sees this as provocation,
yes,
as provoking. And you can add on top of that as well the geopolitical hotspots, not just the economic issues that the United States has imposed, the export restrictions, but again, more inflammatory moves on Taiwan, and then, of course, the no limits partnership that Xi has with Putin. So we already having war in Ukraine as a proxy war for this pursuit of a new world order.
Absolutely. And from a Chinese point of view or from a Russian point of view, the idea that the American-led international order is one in which they should sit where we assign them and behave according to the rules that we have designed seems a little strange. And if you have a Chinese point of view, and Xi Jinping's objective is what he calls make China great again, the great rejuvenation of the great Chinese people. He thinks he's bringing China back to its natural place. He calls it the restoration, its natural place at the center of all the world that it can see. So that, I mean, if you and I were Chinese, we would feel sympathetic to that proposition. Now, the good news, I would say, is that both Xi and Biden, as they discussed in their private candid conversations, both at Bali and then in San Francisco, understand war between the U.S. and China would be devastating for both countries. So neither Biden nor Xi wants a war. Secondly, they understand that they could get themselves into a war, not because they wanted a war, but because misunderstandings and miscalculations and some provocation from a third party, one thing could lead to the other, the way it did in World War I. They don't want that to happen. So they've talked about, and you can see evidence of this in the behaviors, how Taiwan could be very dangerous for both of them. So again, their private, candid conversations about the most delicate issues is exactly what you would like among adults who are trying to manage a difficult situation in which we're seriously competitive, but, excuse me, my survival depends on not getting into a war, and your survival depends on not. So climate is another arena where we are watching and seeing this. And AI will be an interesting area to see whether, on the one hand, it becomes principally a part of the rivalry. That's what I bet it ends up. Or whether they're able to constrain some of the most dangerous applications. Well,
climate is one area where they could potentially, a low-hanging fruit, where they could find some common ground. AI is going to be a little bit more tricky than that. Graham Allison, Professor, thank you so much for being on Bloomberg TV. We could have a whole half hour talking about this. We just scratched the surface here on the second day as we wrap up our Asia coverage, pretty much from the World Economic Forum Summer Davos. I'm Stephen Engel. Has.
And thanks for that, Steve. We know that geopolitical tensions also one of the risks for markets. Plenty more ahead. Keep it here with us. This is Bloomberg. All right, let's take a closer look at markets on the mainland before they head to lunch. A pretty wet day in Shanghai, as you can see from your screen. And Avril Hong is on top of developments. Avril, we had economists pretty upbeat, raising the forecast for China GDP. But you know what? The risks remain.
Yeah, the risks remain. Those concerns about the Chinese economy. I think the performance in the stock market kind of matches what we're seeing in the weather in Shanghai. The equities there are really coming under pressure today. It's bucking the trend where we're seeing a bit of a recovery in the Asia Pacific. It's a tech-led one. And these concerns about the Chinese economy really centered on the property sector. Our colleagues at Bloomberg Economics have been crunching the numbers for the first 2 months of June, and they show those home sales, they've been struggling despite that recovery in the month of May after the government talked about more plans for stimulus for the sector. So that is really at the heart of the issue. Don't forget, and we also have towards the end of the month some of these PMIs coming out from China. They're expected to show for the slowing in economic activity. So this is what we're seeing in equities, and we're also seeing dollar China climb even higher on the offshore yuan, particularly not so far away from the 730 level. Today the PBOC coming through with yet another weak yuan fix. let's flip the board, because despite the selling in the currency and the equity space, we are seeing that rally underway in Chinese bonds across the curve. The 10-year yield hitting lowest level in more than 2 decades. And this rally is really being fueled by the expectations we're going to get more government stimulus, those concerns about the economy. But don't forget also that when we saw those multi-decade lows that these yields hit in April, it caused verbal warnings from the PBOC. It's unclear if they are looking at specific levels, but that is certainly something that we are watching out for. Flip the board again, because as you say, economists are pretty upbeat. They've raised their forecast for the full year for China, and this is really because of what they're expecting out of the outlook for exports. And this raising is quite a fair bit compared to the forecast that it came through in May. You know, it expects there to be rising global demand thanks to a shift towards goods from services demand. Has.
Yeah, that's right. Betting on exports, yet Chinese companies increasingly facing trade tensions, their trade barriers even. Avril Hong, thank you. Well, it's day 2 of the World Economic Forum meetings in Dalian. Let's get the latest on what's been discussed so far with our Chief North Asia correspondent, Stephen Angle, who is at the event, who's been reporting for us. Steve, what have you been hearing? What's been the tone of discussions there?
Yeah, I wish I could go sit in on some of those sessions. I've been right here on camera every hour. That's the big problem when we cover these things. We do meet and talk to the guests, of course, but we don't get to go in and actually hear what they're saying. But I can guarantee you they're talking about the Chinese economy and where it's heading right now, including, Xiaolin Chen, we talked to earlier from Crane Shares, the international head, essentially talking about the lack of momentum in stocks, for one, in China. They got that big boost of policy support like in April, but that's sort of petered out, as Avril was just talking about. They're trying to find some of the catalysts to keep this economy stable, the stock market, give it some wings. But right now it's kind of tough. You also mentioned about that trade action. We've talked a lot about the EV sanctions potentially coming in Europe. We know that the trade barriers have gone up in the United States. So all of these things combined are being discussed here at the Summer Davos, and there's no simple solution, no doubt. We did hear from the Premier Li Qiang yesterday. He talked about bifurcating, or essentially decoupling in this global economy is going to send the global economy and supply chains into a disruptive spiral. And again, we didn't, though, hear any clues really as far as policy directive, which we're waiting for from Beijing next month, when we're going to get the long delayed, 6-month delayed third plenum, where the Central Committee of the Communist Party essentially will lay out its economic priorities and policies for the long term, say for the next 5 years, perhaps even 10 years. So that we will get clues. But one thing that Li Qiang mentioned yesterday repeatedly, that was technology, and technology self-sufficiency. So that will likely be a big priority. But that's a long-term strategy, obviously.
Steve, when it comes to China, it is really an issue of confidence. And it's hard to talk about confidence when we know that tensions between the U.S. and China are likely to ratchet up a notch in the lead up to the U.S. election.
Well, absolutely. That's another thing that has been discussed. And I moderated a panel yesterday on the U.S. economy and where does it go from here. You cannot really have a discussion about the U.S. economy without also folding in the trade issues with China. So that's the 45 minutes, almost an hour, we discussed extensively what would be the ramifications, if you want to call it, of a change in the White House with a Trump presidency. Keep in mind, the Biden administration has talked extensively about their export controls in AI, in supercomputing, quantum computing, and other areas, including the new economy, overcapacity industries like EVs, batteries, and solar. But they also contend that the overall trade tariffs are on just about 4% of overall trade. Keep in mind, Donald Trump has talked, at least on the campaign trail, about across-the-board 60% tariff on all imports from China. So the ramifications of that potentially, again, it might be just electioneering talk by Donald Trump and the Republicans, but again, that raises the specter of a much deeper potentially much deeper trade war between China and the United States. Not to mention, obviously, what we're already seeing between Europe and China, with the German vice chancellor here just in the last few days trying to mitigate any kind of retaliation from China.
And we saw how the yuan slumped under the Trump administration. Our chief North Asia correspondent, Stephen Angle from WEF in Dalian, we thank you so much for your great coverage there. Now, staying with China, tensions with the U.S. are also ramping up on another front, in space. China is now the first nation to successfully return a probe from the far side of the moon. Let's get more on China's brewing space race with the U.S. with Bloomberg's Bruce Einhorn. Bruce, what does this mission represent for China's space ambitions, and what might the U.S.'s response be?
Well, Haslinda, it's a great achievement for the Chinese. They've done something that nobody else has done. They've landed on the far side of the moon, gathered material, brought it back to Earth. No other country has even landed on the far side of the moon at all. China landed there for the first time in 2019. No other country has tried. The United States does have plans. NASA is backing some companies that will be sending missions to the far side, or attempt to send missions to the far side in the next few years. But for now, this is really something that China can notch as a big achievement for itself. It also is relevant for the race that you just talked about between the U.S. and China. Both countries want to send astronauts to the moon by the end of the decade. The Americans have plans to send astronauts through the Artemis program sometime in the next few years is the goal, and that would be the first time since the end of the Apollo program in 1972 that American astronauts returned to the moon. China has never sent astronauts to the moon, but China does have a goal of getting there by the end of the decade. This mission that just concluded is part of a series of missions to explore areas around the South Pole, which is where China wants to build a research station, a permanent presence on the moon. That's something that China is partnering with Russia and hoping to work with some other countries on. The Americans have a rival plan, have gotten a lot of countries involved supporting the American vision for how to proceed on the moon. Both countries are hoping to make progress there in the next few years. This mission that China just concluded also has a lot of scientific value. There's a lot of excitement among scientists in getting access to these samples that were taken from the far side of the moon, which is very different. The composition of that side of the moon is very different from the side that we see. So there's a lot of opportunity there for potential opportunity for scientists to learn more about the moon's origins and maybe even the Earth's origins.
So China has big ambitions in space. Some say perhaps that the slowing economy could be hindering those ambitions still. Bloomberg's Bruce Einhorn, we thank you so much for that. Now, Japan's Takeda Pharmaceutical says it sees multiple growth opportunities for the drug maker, including new treatments in the pipeline and the growing use of AI. Bloomberg's Isabel Reynolds spoke exclusively with CEO Christoph Weber and began by asking about the potential impact of the U.S. bill seeking to sanction some Chinese biotech firms.
Well, in our case, it won't impact us much because we have no dependency on any Chinese company. We work a little bit with some companies, but it's a very little engagement. So we won't be impacted so much. We are growing very fast in China. Our business is growing very fast, but we made sure that we have no dependency from any Chinese company in our global operation, if you like.
I also wanted to ask about your drugs pipeline, and what can you tell me about the most promising drugs that you have coming up? What we've seen is that you have high expectations for, let me see if I can pronounce this right, zasocitinib for psoriasis, and a drug also for sleep disorders.
Yes,
Can you tell me about those and perhaps any others that you're...
Yes. So we have 6 molecules in late-stage development, so what we call late-stage development, meaning that it's the last stage before filing and potentially getting approval. All 6 are very exciting for patients, but in terms of revenue potential, the two you mentioned have the highest revenue potential. So I'll start with TAK-861. It's a molecule to treat narcolepsy, which is indeed a sleep disorder. We are about to enter into phase 3, so we are very excited about that molecules. The second one is zasocitinib. It's TYK2 inhibitors. We are developing it first in 4 indications: psoriasis, psoriatic arthritis, ulcerative colitis, and Crohn's disease. So this is a molecule with potential to treat many indications. The goal here is that to have very good efficacy, but oral, so much more convenient to be used. So that also has a very high revenue potentials, because just these 4 indications are very large indications.
One of the themes we're looking into this year, I mean, not only at Bloomberg, but I guess around the world, is AI.
Yes.
Now, how far is AI already a part of your sort of development of new drugs, and how far do you expect it to develop in the future as one of your sort of tools?
On one side, we are at the beginning of the use of data on AI, but we are moving very fast. So this is a very big agenda for us. We see already some application in research to design molecules, for example. We see application in development to accelerate our clinical trials, to design better our clinical trials. We see application in manufacturing, quite a lot actually, where we combine image recognition and machine learning to improve our manufacturing operations. We see application in commercial as well to have a better interaction with doctors. So we are moving very, very fast. So it will completely transform the company in the next 3-5 years. Yeah.
Today we've seen the yen fall back near 160 again against the dollar. It's a benefit for some companies, it's a pain for other companies. What is the effect on Takeda Pharmaceutical?
For us, 50% of our revenue is in the US, so the yen depreciation is a tailwind for us. But that's a short-term tailwind, because if the low yen is impacting negatively the Japanese economy, eventually healthcare financing is linked to the GDP. And so if the Japanese economy is impacted, it will be secondary impacted, because there will be less financing of healthcare. So I think in the short term it's a plus, but long term, if the economy is facing a downside scenario in Japan, it will be negative.
Takeda Pharmaceutical CEO Christoph Weber speaking with Bloomberg's Isabel Reynolds. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching India Focus. India starts trading in just about 10 seconds from now, ticking away. Of course, this is a market that's back, being the darling on the back of those election results. Trepidation, no more. Investors back buying into this particular market, which is trading close to record highs. The Sensex today, though, pretty unchanged. And we have the Nifty Bank Index slightly in the positive. One stock we may be watching today is Adani Group, doubling its capital spending this year, accelerating investments in green energy as well as infrastructure projects. That means ports, airports, and roads. Yet another sign that it's put the fallout from the damaging Hindenburg report behind it. We have the Indian rupee 83.43, pretty unchanged versus the USD. Now, the Reserve Bank of India Governor Shaktikanta Das says the nation's growth momentum is very strong. Speaking at an industry event, Das said the RBI was confident in its growth projections for the year and that models suggest even stronger momentum ahead. Das added it's essential to keep inflation in check.
I mean each and every word of it. I repeat, India is at the threshold of a major structural shift in its growth trajectory, moving towards 8% GDP growth in a sustained manner.
Well, let's get a reaction from our next guest, who has over 16 years of experience in fund management and credit. Vidya Iyer is head of fixed income at ICICI Prudential Life Insurance and joins us from Mumbai. Vidya, good to have you with us. Das seems to be upbeat, sustained manner towards 8%. Do you agree?
I do concur with the RBI governor. So RBI in its last MPC meeting had upwardly revised the GDP forecast from 7 to 7.2%. I clearly see there is an upward revision bias to that number. So all the concurrent high-frequency indicators that we track internally are continuing to show very steady growth. So clearly there is an upward bias to the projection that RBI has given, and I think the market will also follow suit in terms of its estimates. So I personally feel a 7.2 to a 7.5 number for this fiscal year is very clearly achievable, purely on the back of continued government spending and a very strong consumption growth domestically.
Of course, Das also talked about how India needs to keep inflation in check. What are the risks going forward, you think, especially on the back of geopolitical tensions, which might see oil prices heading higher?
Right. So if you see the headline and the core CPI number for the past few months have, on a sustained basis, been on a downward trend. And I do think that inflation going ahead will remain well anchored. Of course, as you rightly mentioned, the geopolitical risk in terms of its impact on the crude oil prices will be a key monitorable. Another monitorable with respect to India specifically is how the monsoons play out and, its impact on food inflation. So barring these two risks, I think we should see an inflation which is very well anchored. I expect the inflation to average around 4.7% for the year. And this should give more than enough elbow room for the RBI to cut rates in the later part of the year.
Vidya, part of the euphoria in the Indian market has to do with India's inclusion in the global bond index. A lot of people say it's been fully priced in. How does India fully benefit from this inclusion? What does it need to do?
Right. So, Haslinda, just to give some context, the Indian bonds have done extremely well for the past year. In terms of market positioning, the domestic investors have remained fully invested and are sitting on long duration. From an FII flow perspective, we've already seen $10 billion of flow coming in since September 2023. So, given the overall positive structural outlook on India, the consensus view is that the bonds are going to head southwards from here. And as we get closer to the inclusion, we have the first tranche of inclusion, which is kicking in day after tomorrow. The positive momentum has just, picked up pace. So yes, you are right to the extent that broadly the market is positioned for the inclusion. And therefore, I do not expect any immediate movement in the bond yields on the day of inclusion. However, if you were to look at it more from a structural long-term perspective, I think the move in bond yields is not yet done. Because India is in such a sweet spot right now. And I truly believe that India will continue to remain a very preferred investment destination. Whether you talk about strong and stable macroeconomics, you talk about very prudent fiscal policy by the government, a very proactive central bank, a very stable currency. It's a perfect mix, and that's why the Indian bonds have remained very well anchored. And another point which I wish to highlight here is the kind of growth the real money domestic investors, such as insurance firms, pension funds, provident funds, have seen significant growth year on year. And given the kind of business these investors are in, the demand for long bond is here to stay. And with the FII flows also kicking in, if you see the constituents in the JP Morgan bond index, the maturities above 15 years is almost 40% of the index. So that is further going to add to the demand scenario. So to say, in the last few years, the supply-demand landscape for India has changed for the better. So in a nutshell, all these factors bode very well for Indian bonds.
We're seeing a lot of interest from foreign investors, foreign funds as well. And just wondering, does it make Indian bonds more susceptible, more vulnerable to sudden withdrawals? Is that a risk?
I wouldn't agree because, if you see the percentage of FII holdings to the overall government debt, it's very minuscule. You know, the Indian government securities market is roughly 1.3 trillion. And the FII holding is hardly 1 to 1.5% as compared to China, which is at 11 to 12%, Indonesia, which is upwards of 30%. So India still has a long way to go till we reach a point where sudden outflows really have a bearing on the market. And also we need to understand that the Indian government security markets in itself is quite a vibrant and liquid market. So unless we reach a point where FII holding in the government security market really becomes a very meaningful size, I don't really see that as a challenge.
All right, Vidya, thank you so much for being with us today. Vidya Iyer, ICICI Prudential Life Insurance. Plenty more ahead. This is Bloomberg. And here's some of the top global stories we're following. Julian Assange has walked free from a U.S. court after pleading guilty to leaking national security secrets. It ends a 14-year legal and political drama that has seen him imprisoned in the UK and in self-imposed exile in a London embassy. The WikiLeaks founder entered a plea in a U.S. courtroom in Saipan. The agreement resolves an international fight to prosecute Assange over the leak of U.S. military documents and diplomatic cables starting in 2010. The Philippine ambassador to Washington is warning that the conflict with Beijing in the South China Sea could engulf the Asian region. Speaking with the FT, Jose Manuel Romualdez says tension over a disputed reef has created an incendiary situation. Earlier this month, a clash at sea of a Philippine mission to the reef injured one Filipino sailor. And New Hampshire is suing TikTok for allegedly misleading users about the safety of its design features and protection for children. The complaint accuses the social media platform of exploiting young users for profit by creating an addictive product that's harmful to their mental health. A spokesperson for the company says the app has industry-leading safeguards to support teens as well as parental controls. Let's do a check in the markets. Aussie assets in particular on the back of that inflation accelerating faster than expected for a third straight month in May. Aussie dollar higher as traders boosted bets the RBA will resume raising rates at its next meeting. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. This is Bloomberg.